Thanks a lot, Anil, and thanks for the invitation. As Anil said, this is a co-authored work with my colleague Gary Gorton, who is sitting here. And I'm going to try to go through 100 years of regulation in 20 minutes. I'll start with a thank you to Rick Mishkin for dressing like me today, so I'm not the only one who is obeying the normal Summer Institute dress code, not changing it around. So what I'm going to talk about is, for anyone who's seen the paper, I relatively quickly go through a lot of the main topics in the paper. Focus on the beginning. I have 100 years, but I'm going to focus most of the attention on the founding of the Fed in the 1920s and the Great Depression. This is where we think we have kind of an interesting theme that then holds and continues throughout all of the Fed's history and is still with us today. That's the first few topics. Talk about the legislation in the New Deal period, and then the transformation of banking that kind of ended the quiet period, and a variety of things that we know have happened recently, such as the financial crisis and the Dodd-Frank Act. So the main theme, looking at this kind of regulation over 100 years, regulation by itself is not tremendously central to what the Fed has been thinking it does, I think, for most of its history, if you just think about regulator. But the lender of last resort function is really something that sits right in between being a supervisor, a bank supervisor, and a monetary authority. And the Fed was, as we've heard people talk about, founded in large part to prevent financial crises, and the discount window, which is its main way to go and do that and create an elastic currency, from its founding and going forward, had a variety of functions. And our theme here is going to be the tension between those functions and how that has actually limited and created barriers for the lender of last resort function to work as well as it can, and that's still with us. It kind of created that with some confusion in the 1920s, and that's still with us. So that's what we're gonna do. Okay, so first, just one slide to think a little bit about why we regulate finance at all. Why is it different than the shoe industry? So, what are we thinking about? And we usually start with the idea that there's significant information asymmetries in this market, and that there are also potential negative externalities, kind of two different things. On the information asymmetry side, for many financial transactions, we're going to just think that the seller has, and sometimes the buyer, a lot more information. One party has a lot more information than the other. That's a market failure. We should go in and do something about that, and we do. That's not mainly what the Fed does, unless we're going to count the CFPB really as part of the Fed. It's mainly done by the SEC, the CFTC, the CFPB, the FTC, and a variety of state authorities that would be very involved in this kind of consumer investor protection side of financial regulation. More interesting, I think, for us in this room and for the Federal Reserve are the potential negative externalities of liquidity demand. So in crisis times, what is obvious is that liquidity is a limited common resource, and everyone wants it. And in normal times, what happens is, we create lots of additional liquid securities. When I create a liquid security, I don't consider the externality that's going to cause to the system if all of a sudden at the same time during a crisis, people are going to demand it. Okay, so going back to Doug's work with Phil Dybvig, we kind of have a nice formal way to think about that. And really, it's in the normal times we can get an overcreation of liquid securities. So we have to think therefore, how do we deal with these two problems? And that's a tension that's going to be there from the beginning. Okay, at the time of the Fed's founding, we've heard some of this already today. It was the prevent banking panics through the creation of an elastic currency. And we're going to do that predominantly through the discount window. This is right in the preamble to the Federal Reserve Act, as is improved supervision, whatever that means. There's a notion that at the same time that we're going to be lending to people, we're going to need to be supervising them. As we heard this morning from Julio, the founding of the Fed was also the product of numerous compromises. And those compromises ended up embodied somewhat in the discount window and its function. So one of the things, and this is also in Barry Eichengreen's paper, one of the things that it needed to do was have a national market, a very deep market for bankers' acceptances so that dollars could compete with pounds. And that's somewhat similar, but not exactly the same as elastic currency. You really need to be in the business making sure that we have a deep market for buying and selling real bills. And then the other thing was it was politically weak, and at the time really needed to be nice, and this continued for some time until after World War II, to be nice to Treasury and let them borrow cheaply, particularly during and immediately after World War I. So the discount window had a lot of these functions, and as we'll talk about later, the discount rate for quite some time was below the prevailing rate on commercial bills. So that's obviously going to create a lot of people borrowing from the window who don't necessarily have to. It's a cheap way to get. So our paper has no theory and very limited data, mostly stuff we stole from other people. So no regressions, but lots of quotes. So really I'm back to the days of junior high school when I would just take quotes. I'd say 5-page paper, I can do that. And so I'm just going to show you a few of them here. I mean, I'm not going to read all of them, but the basic idea is that at the time that the Fed was created, the idea is it's going to prevent banking panics, not be there when the panic starts, but rather because it is there, everyone will know that when banks need liquidity, they'll be able to go to the Fed, they'll be able to borrow, and thus we're not going to have a crisis. This is a very important point, which I had no idea, sadly, because of the weak education that we get these days. I had no idea of this important history, that it wasn't just being a lender of last resort in the crisis, but rather because it would be there, we wouldn't have a crisis to begin with. Try to find a good quote here is from Robert Owen, who is, this is the middle quote, Senate sponsor of the Federal Reserve Act. You can see, gives assurance to businessmen of the country that they never need fear a currency famine. It assures them absolutely against the danger of a financial panic. And then in the middle of the next paragraph, the controller of the currency announced in 1914 with the new Federal Reserve Act, financial and commercial crises or panics with their attendant misfortunes and frustrations seem to be mathematically impossible. So sort of the law of physics is such that we cannot have this. You're very happy about that, Ben, right? So you don't have to... Nothing to worry about here, move along. All right, so then what happened in the 20s? Very important is that in 1920, 1921, we had a deep recession. And recessions of this severity during the national banking era always led to a banking panic. How can I be so confident saying always? It was in Gary Gorton's dissertation. Okay, so ran regressions and showed that if you ever got pig iron down too far, you would have a banking panic. And indeed, that's what we would have expected in 1920 from that same regression. It didn't happen. Okay, and why didn't it happen? Well, it seemed like the Fed was kind of doing its job. Discounts and advances comprised the majority of bank reserves by 1921, 82% of the Fed's balance sheet. At the moment, 60% of member banks were using the window. And the discount rate was below the commercial paper rate, so it was really easy to go and do that. Okay, so the 1920s beginning, that's how it starts. And everybody at that time was of the opinion, all right, what just happened? The Fed saved the day. This is exactly what was supposed to happen. Okay, so again, I have a bunch of, this is evidence. These are why the paper can go into Econometrica. Look for a really good quote would be at the end here. And there's a lot. If you look at the paper, you'll see we have a lot of quotes even after Christine, David, and Neil made us take many of them out. There's still many there. By permitting rates to remain below open market rates and credit to be expanded during the period of deflation of prices, it has prevented the present business depression from degenerating into an old-fashioned panic. So all over you can find quotes. Contemporary quotes are like, okay, this is, yeah, we're used to seeing panics. No panic this time. Okay, so that's important. Here's what we see happening. This is from Talman. My screen seems a little messed up. The red line is the discount window borrowing. You can see how high that went. This was actually a lot of money in 1921, so we're over $2.5 billion. And it starts falling off after 1921, rises a little bit, or what at the time seemed like a lot, in 1923, 1924, and then kind of falls off, never really hitting levels. Discount window borrowing, this red line is going all the way through 1935. It never really hits a big level again, which seems funny. So why weren't people borrowing from the discount window as we started to hit the Great Depression? And the answer to that question is because of these conflicting goals, the Fed and the markets altogether created a certain amount of stigma towards borrowing. Okay, now what was that? Here are a variety of quotes. Again, This is from the Federal Reserve's annual report in 1926. Okay, I'm just going to start reading from the middle. The funds of Federal Reserve banks are ordinarily intended to be used in meeting temporary requirements of members, and continuous borrowing by member bank as a general practice would not be considered consistent with the intent of the Federal Reserve Act. That seems logical, but if it starts bothering you that the banks are borrowing so much, what do you do? So they're going to try a variety of things, okay? And they're bothered also by the fact that the purpose of the borrowing, we heard this in Julio's session early this morning, they want to distinguish between speculative security loans and loans for legitimate business. So the 1920s were a very interesting time, right? And we heard the word penitence this morning, and I think that's just a great way to think about it. We hadn't thought about it that way before, right? We were banning alcohol in the 1920s as well, right? We really, morally, it just seemed wrong. You were borrowing from our discount window, you were using it for speculative purposes. What are we going to do? One thing that the Fed tried was to have different discount rates for different types of collateral, and it turned out, surprise, surprise, that the banks were able to work around that. So it was not really workable, right? So what happened? This is what Chandler says. So it's not us, it's Chandler, so it must be right. In short, the whole attempt was a failure. Loans on securities continued to rise up onto the eve of the crash, and restrictive efforts were not selective. Credit of all kinds to all kinds of users was restricted. Governor Harrison later claimed this whole moral suasion effort aimed at borrowing members made banks less willing to borrow at the Fed in the early 1930s. Whether or not this is true, it is plausible. We'll take plausible. Okay, so really what we have going on in the 20s is a variety of things. We want to help England get back on gold, and we want to help England stay on gold, and so we're keeping rates, want to keep rates low to let them do that, but if rates are low, everybody wants to come borrow and speculate into the stock market. Well, we can't let them do that, so we're going to really push back. We're going to say no. We're going to yell at them. We're going to let it leak to the market that they're borrowing and they're weak. We're going to do everything we can. Moral suasion, direct pressure, those were the words that were used. And it worked. Okay, we saw in the previous picture that the amount of borrowing went down. So what happens then? The Fed entered the Depression era with a stigmatized window. I'm not sure if that's an actual word you can say before window. Stigmatized, but we're using it. So there's a stigmatized window, and we argue in this paper with supportive quotes from Chandler and Friedman and others that understood at the time, there was a reluctance to borrow by banks. So they didn't borrow. Here we go into the Depression thinking we can't have bank runs. Bank runs are mathematically impossible. And now we start seeing that banks are in trouble. They weren't borrowing. They were afraid to borrow, and they really just started to run out of money, and we did get bank runs. So it was puzzling, we think, at that time to everybody. Now, where banks did borrow, in some Federal Reserve districts, they did borrow, banks did a whole lot better. But in many places, the stigma was there, and the stigma was strong. More evidence of the stigma can be seen in extensive borrowing by the Reconstruction Finance Corporation, which was significant. There were 17,000 banks in existence just prior to the banking holiday of 1933. Only 12,000 survived. Half of those were borrowing from the RFC. Okay? RFC borrowing itself leveled off following new rules for disclosure of borrower names. Bloomberg sued in 1930. No, I'm sorry, that came later. But others had forced the names to be disclosed on the House floor. And here's what happens. If you look at the picture, the black line is bank borrowing. Mostly when we think of RFC loans, we think, wow, they were loaning to projects and dock workers and docks and things like that. Now, there's a lot of bank borrowing, and it went up a lot to $500 million, again, a lot of money back then, in 1932, which is when they started releasing the names on the House floor, and it leveled off. So the RFC had some stigma created. All right, I have spent 14 minutes on the first 14 years of the Fed, so now I have 6 minutes left for the rest. So let me go fast. Just going to put this up and talk about the main things here. Okay, so there's a whole lot of New Deal legislation, which is very important now. Now we're going to realize we had a problem. Some key ones people don't often talk about: the Emergency Relief and Construction Act of 1932, which created the RFC. That's also where we introduced Section 13.3. It's the first introduction of Section 13.3. There were amendments later, particularly in the Banking Act of 1935, that made sense. What I want to say here, and I think is important, is the FDIC was originally written in as an amendment, as part of the Federal Reserve Act. So we have deposit insurance very much thought of as part of this same role of the Fed. We have a long, quiet period now from the New Deal. This enables me to skip many, many years. A long, quiet period where very little of excitement happened in the regulatory world from after New Deal legislation until the late 1970s, except for two things I should have mentioned on the previous slide. The Fed Treasury Accord, which did in 1951, which really finally gave the Fed a much more independence from Treasury. And if you look, that's the bottom of interest rates, and then they just start going up and up and up, and that's going to matter. Okay? And then the other thing was the Bank Holding Company Act of 1956, which provided a lot of opportunities for the Federal Reserve to have much more oversight over the banking industry, especially in the long run. So beginning in the late 1970s, what do we see? We see a lot of competition, largely coming from this rising interest rate environment. So this is why we cannot separate monetary policy from regulatory policy. They're not different things. It's fashionable and I think correct these days to talk about how monetary policy and fiscal policy are really very closely linked. Can't separate them. The same really seems true of regulatory policy. Starting in the 70s, in the rising interest rate environment, money market mutual funds began to really compete hard with banks. We see they go from 76 million in deposits in 1980, or money market mutual funds and assets, to 1.8 trillion in 2000. There were a variety of changes made in the early 80s to allow banks to compete. So regulation was reacting to the higher interest rate, to the changes in monetary policy. So the DIDMCA, we see that in 1980, and then the Garn-St. Germain in 1982, that are going to enable banks to compete. Now what happens? We get an S&L crisis. Anil wants me to talk a lot about that. All I'm going to give him is this little slide. Running out of time. Post-crisis legislation. Financial institutions reform. We have Ferrea, Fiducia, and then Regal Neal and Graham Leach Bliley. So Anil wrote a whole paper about this. You can read it. It was in Brookings. Yes, it was in Brookings. But what's going on here? We have to clean up after the S&L crisis. So we had rising interest rate environment. Again, monetary policy connected with regulatory policy, and we're going to have to react to that by cleaning things up afterwards. All right, I'm going to skip Basel and go to the financial crisis. So what happens? The Fed begins the financial crisis with two major impediments to its lender of last resort function. Stigma. So among eligible banks, if you can go to the discount window, there is still stigma. It has stuck since the 1920s. And there is a lack of reach to many important non-bank institutions and markets. So we're no longer able to lend to everybody who is necessarily doing liquidity transformation. There was a policy change in 2003 to create several different categories of discount window lending, attempting to combat that stigma. It didn't completely work. The term auction facility, the TAF, was designed to get around that problem December 2007 and seemed to work pretty well. I won't get in trouble for saying that at an NBER conference. There was extensive use of 13.3 powers during the crisis. That expanded the reach of the Fed. So these two pieces, dealing with stigma and dealing with reach, were both dealt with creatively, but they were not, we weren't able to completely work around them. So what happens in DFA? First, Section 13.3 powers are restricted. So now only broad-based programs are allowed, more congressional oversight. I'm not sure how worried we should be about that, but certainly it's restricted compared to what it was before. The Fed has been granted authority as a primary regulator for systemically important financial institutions and utilities. Stress tests, this is very much a strong supervisory, part of the supervisory toolkit. Now it's permanent. And there's a key role for the Fed in the orderly liquidation of non-bank financial institutions. Okay, the biggest gaps, we think, that are still left are in the regulation of shadow banking, kind of all these places where you need to have more reach, and in cross-border issues. So where does that leave us? The Fed plays a crucial role as lender of last resort to prevent and mitigate panics. The role must be combined with regulations and oversight in normal times to avoid buildups of risk that would make the panics more likely or be costly to safety nets. So if we're going to insure them, we've got to watch them. This has been a difficult balance for the first century. What are our challenges going forward? First, the expanded lending programs, we took them all away. There's a sense, if we go back to the way we think about the founding of the Fed, the idea was we're not going to have panics because we know this thing is there. Well, we took these away. Should we have taken them away? Or is there any way to get them back? Do we want them back? Okay. Is there any way to destigmatize the lending programs we do have? This is just a challenge. Right? We can't do all the things we want to be able to do if our main technique for preventing panics is viewed as stigmatized. And then finally, we've heard this word macro-prudential before, but what do we do in normal times? What are the tools we should be operating in normal times, and how are they different from what the tools were over the last 100 years in order to be able to watch over the safety net. And we're seeing a lot of that now with changes in the capital rules, different ways that we're thinking about supervision. But I think the jury is still out. It's going to be a long time and a lot of work for a lot of people. Thank God, makes our jobs interesting. Okay, that's it.